Howdy, Jacob here. Today we're looking at CVS Health in the healthcare providers and services industry. They provide health solutions in the United States. They operate as a huge pharmacy supplier and wellness provider. And, similar to a Walgreens, they also just have other things in their store, a lot of over-counter medicines, and they have gotten into the health insurance industry, which will help their growth, but will very likely not help their margins. And so we do see a decline in operating margin from 6.3% to 4.1%, and also a decline in gross margin from 18 to 15%. However, revenue growth is absolutely out of this world, from 140 million, 139 million to 358 million after 10 years, with a dividend that has doubled, but it is still not immense in relation to their earnings. We'll see what it is in relation to free cash flow. Return on invested capital has gone down because their earnings are not growing as fast as revenue. And so, um, if you have more on your balance sheet, and you're not making as much, it's going to decrement that return on invested capital, which we see over here was almost double digits 10 years ago, 8 years ago, and then now it's pretty much 4, 5, 6%, which is not very grand. Their income statement shows that cost of goods sold is a heavy expense for them, and then there's just other expenses. Balance sheet has about 11 million in cash-like products, with 2.9 billion short-term debt, 59 billion long-term debt, and 16 billion capital leases. So there was a huge acquisition, 2017, 2018. Let's see what that was. Yep, $41 billion net acquisition. That's almost their market cap right now. That's crazy. So that got them into 50 billion extra in debt almost. And they've slowly been paying it, or they paid it off consistently for 3 years. And then looks like the most recent year, there was a net acquisition that had them go into debt again. So their cash flow is pretty heavy on net acquisitions, not consistently, but every couple of years they make a pretty large acquisition. We see 11.4 billion in 2015, 41 billion in 2018, and then 17 billion in 2023. Outside of that, they do reinvest back into themselves with maybe 10, 15% of their cash, free cash flow. They buy back some shares. They issue a dividend that pays out $3 billion. So that is definitely not much in relation to their free cash flow. If they're able to get back to that 10 to 15 million, you're looking at about 30%. But for me, again, I have to balance out what I want the company to do with what they've done in the past. And so for me, with how much debt they have, this 50, let's say $60 billion in debt versus $10 billion in free cash flow roughly is going to be take about 6 years to pay off. And so I think that if they used 100% of free cash flow, which they're absolutely not going to do, so I have to balance out them paying maybe anywhere from 20 to 50% of their free cash flow to go to debt reduction, which again is going to take away from their reinvestment capabilities, acquisition capabilities, repurchase capabilities. And so let's get to it right now. I think their growth is going to be pretty solid. I think that their pharmacy section of the health insurance world is going to grow like crazy, just because pharmacy trend is out of this world. But I think 7% seems pretty reasonable to me. But that 7%, although it has high growth, is going to dampen margins likely. And so it's not hitting the bottom line as much. It's not making the company more efficient. So for me, it wouldn't really deserve a premium even if it had no debt. And it does have a lot of debt. So even at the end of this 7-year projection period, I still think that their enterprise value is going to be quite large in comparison to the market cap. And so to me, I think a 10p makes sense. This is where the subjectivity comes in. Do what makes you comfortable. But I do love that free cash flow is much more consistent. Maybe I'll do 3 and 3.5 with a share change of 1% is about 700 million. 1.2 to offset stock-based compensation leaves a good amount of room for debt reduction. Their dividend pays out a good amount. They haven't increased. They've kept that steady for a little bit. I'm going to keep that steady. And we're saying it looks like a good deal right now. So for me, right now, with these assumptions, it looks like a good deal. I'll probably do a deeper dive soon. But again, even if you come up with a valuation based on earnings and free cash flow that makes sense, you have to get comfortable with that debt. Because like I said, they did decrease that debt for 3 years very consistently from 71 billion to 59 billion or 52 billion in 3 years. They destroyed that debt. But then the next year they only dropped a billion, and then they made a large acquisition, and they issued $8 billion in debt for it. And so, will they pay it off or will they dampen it to maybe 2 to 3 years? I don't know. And I'm just not confident in that. So in doing a deeper dive, again, even if the numbers make sense, you have to balance out the realisticness of the balance sheet. And so right now looks like a pretty decent price, but again, we'll do a deeper dive in a little bit. Thank you.